Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. And I want to thank you for joining that mission today. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guests, Harley Bassman. Harley, are you ready to join the mission?
Rock and roll, man.
Literally. Let me introduce you to the audience. Harley is an industry thought leader and commentator on macroeconomic issues spanning decades. He spent 26 years at Merrill Lynch, and from 2014 to 2017, Harley was an executive VP and portfolio manager at PIMCO. In 2011, he joined Credit Suisse's Global Rates, and in 2006, he built the Rate Lab, a full spectrum U.S. rates trading desk strategy group. Presently, Harley is a managing partner at Simplify Asset Management. He continues to pen an episodic macroeconomic commentator as well as manage a hedge fund of one. Harley has a BA in management science from the University of California, San Diego, and an MBA in finance and marketing from University of Chicago. Harley, take a minute and tell us about the unique value you are bringing to this wonderful world.
Well, as you can tell from, I guess, both of our hairstyles, old age. This reminds me of my very first job on Wall Street. So I went from college to business school. You could do that once upon a time. And so I get my first job at Drexel Burnham on the trading desk there. And our boss has a sign on his desk, and I didn't like the sign at all. But now I look from store to store for this sign. Age and treachery will win out over youth and skill. And so now I am old and treacherous.
Okay, so age and treachery will I can understand the age will win out because maybe we've been through all those battles, but what does it mean, treachery? Bad behavior?
No, it's a matter of just being quick on your feet and having seen the movie before. It's never different this time. So as a early plug over here, I write a macroeconomic commentary every 4, 6, 8 weeks whenever I'm in the mood. It's all posted on convexitymaven.com.
Yep.
My email's there. Just send me an email address and I'll add you to it. So it's all free, and it's I wouldn't call it easy reading, but it's okay. It's okay.
And how do you approach macroeconomics? Where is your mind when it comes to that? I'll have a link in the show notes, by the way, so people can check on that.
I try to work with common sense, which sounds like a juvenile thought, but it really isn't. Like when I was at Merrill and we had the new MBAs come on in for training, they knew a lot. They're all smarter than me. They could program and they could do this, they could do that. They did not have common sense, and they didn't have it because it wasn't required. What's required to get from college to grad school to MBA to Wall Street, you have to be able to work a spreadsheet. You have to be able to get the right answer on a test. You have to evaluate, how to create a number or something. But actually sitting back and thinking, like, does this make sense to me? That's not required to actually go and get a job and succeed, at least in your early years. That usually takes getting hit in the head with a baseball bat to learn that. So I can talk about it in option terms. I'll talk about it in simple terms. I don't skydive. Now, I would love to skydive, by the way. I think it'd be tremendous fun. If you put hot fudge sundaes as a utility of 10 and sex as a utility of 100, skydiving might be a utility of 1 million. It would be great. But you got to go and PV that whole concept. So you have to take the odds of me having my skydive at 1 million of utility times 0.999999, and then pulling the cord and just having cord, and you're very high up. So you're going to fall for a long ways before you hit the ground. You have time to think about things. That's negative infinity of utility. And so 0.0001 times negative infinity is negative infinity, and thus I don't skydive.
That's funny because remember I went back, haven't been in North America for a long time. And many years ago, I went back to visit my sister, and, she's into skiing, and her kids are, and all the kids got together and we went to ski slopes, and I got to the top of that mountain and I thought to myself, I haven't been skiing in about 20 years. The risks of me breaking my leg are really, really high. And I just said, you guys go ahead. And I just like carefully and slowly went down that mountain. But I also thought to myself, I don't think it's worth it for me to ski if I'm not doing it on a regular basis. And so I kind of stopped that, what I consider to be high risk, behavior for me, because I wasn't training it. But the death part is not a part of skiing, just the discomfort of breaking the leg and all the other implications. But the death part is the infinity, I guess.
I think if you really snapped your leg off on top of a mountain, you might wish you were dead.
Yeah.
But I mean, if you think about it, common sense, skiing is pure idiocy. You're slapping on two pieces of wood and sliding down a mountain of ice. That's kind of stupid if you think about it.
Yeah. Well, hopefully my sister doesn't hear that, or else you may get a letter. Now, I'm just curious, I look at the US after 31 years of being out of the country, and it's kind of baffling what's happening. What I remember when I was young was that there were some responsible people around who, did responsible things, like kept things, budgets in balance, and tried to do that. But now it seems like that's just impossible. And now it's gone so far with government spending, government debt, the Fed coming in, and it's just like, where does it end?
You can. There's two different paths to go think about this. One of them is that we had the GFC in 08, 09, and the Fed printed money to go and salvage the banking system. And are the bankers good guys? No, they a lot of them should have gone to jail. But we need the banking system. We're a financial world. You need and we're the plumbing. The banking is what's the plumbing. So you have to say the plumbing. You could have got rid of some of the plumbers. But then the Fed comes in and they print money, and they wanted to create inflation. And they wanted to create inflation because we had too much debt. Mortgage debt, corporate debt, government debt. The only way you get out of debt is to either grow, right? So the ratio goes down, or you default.
And keep the debt the same level.
Yeah.
Right.
That was after World War II. You had the economy grow faster than the debt, and you bring it back in balance. The other way is default. Like the debt just goes away. Defaulting is unpleasant because people lose their jobs. So the better idea is inflation. Inflation is basically a slow motion default, as the value of what you're getting back in the future is reduced. It's effectively a silent tax across the entire country. Everyone pays it, and no one sees it. I mean, it's hard to raise taxes on the middle class, but you can raise them on the rich, but you can tax the rich 100%, and that won't solve your problem. Inflation is the way you tax the middle class, the great majority of the people, and no one really complains about it. And as long as it stays at 1%, 2%, 3%, you're okay. When it gets up to 6, 7, 8, 9, then you got a problem. Fed printed money, tried to create inflation, and lots of naysayers say they didn't. That is false. There's tons of inflation. It was asset inflation, stocks, bonds, houses, cars, boats, gold, art. It all went up.
Yep.
And the problem you had was to win with asset inflation, you had to have assets. Well, who has assets? The rich. So we basically had this widening out of the wealth income disparity. And that's really where I think caused the problems, is widening out. What is the Fed at fault? Yes. Was it intentional? No. They were trying to do a good deed by creating inflation to devalue the debt, but it ended up being asset inflation. And this, I would say, this is why you have Trump. It's creating this widening gap of income and wealth. And then the fiscal policy came in with COVID, and that finally got the real labor wage inflation, which has now really kind of jumped things up. And this is a problem. The other issue really is seemingly this idea of we're no longer a community. We're no longer a team. The individual is more important than the group. You know, why is that? Maybe Twitter, maybe other things, unclear. But I mean, you've lost the ability to go and do something for the team, to sacrifice for the team, to compromise for the team. Our politicians, they don't compromise at all. It's all or nothing. It's a win or it's not. And when you do that, you end up with a bad situation when you're trying to operate as a team, as a country. And we've lost that ethic. Why? Maybe it's linked to finance, maybe it's not, I don't know, but that certainly is the biggest problem we have now in our politics.
And you can feel that. You can feel that in, you know, when you look at your span. I mean, sometimes as we get older, we look back at things and we think that they're the glory days. And I'm just curious if, you know, to what extent do you really clearly see that difference compared to the past?
I mean, look, were the good old days that good? I mean, in my lifetime, we had black and white water fountains, for God's sakes. I'm a little older than you are. So I mean, I'm not sure the girls were all that good,
right?
But they're different. I mean, I live in a community, and I'm on the board of this community. And when you want to build a house, you know, tear it open, build a new one, you have to apply, and it is becoming more and more difficult to manage this process when these people come in, they buy the property, and they want to do what they want to do, and maybe this house is not harmonious with the rest of the community, and other things where it's not. We have an old community in California, and we want to kind of keep it in a kind of, I won't say rustic, but kind of low-key California way. People want to come in and build a 10,000-foot house with 10 cars. It's like, really, man? It's like that kind of doesn't fit into what we want over here. We're not ostentatious. We're like low-key. And how do you go and control these people who they want to come in here and do what they want to do, and they don't want to go and, compromise in the community? And the word compromise has become a dirty word everywhere. I mean, even, I'll make, most of my, this is not one of my worst trades, although right. I guess some of them could be, is I'll invest in a startup of some kind where I know the person and it's a good idea and it might work. I won't, but it might work. Most of the time, what I've found is the person will get the project to a place, and then he's kind of gotten his level because it's only one person, and it's time to go, and he will no longer own 80% of the company. He's going to own 40 or 50 or 60, whatever. Maybe it'll be 40. He will no longer be in control and own the whole thing. He does not want to do that. He wants to go and keep control of this thing and not sell any equity at all. And that's usually when these things go, on the rocks. It's ego, it's control, it ends up, I mean, my comment always is, isn't a half loaf better than no loaf? And my experience is people, they want the whole loaf and the whole thing goes into the tank over and over and over again. I mean, this is why, like, we still read the Greek tragedies from 3,000 years ago. From 300 BC, we read Shakespeare. What is always the downfall of man? We still read these books for the same reason. It's hubris. It's ego. Right now, we have the same problem. I mean, we got one, by definition, narcissist who's running for president again. It's always hubris or ego that is the killer.
Yeah.
And it's never different this time. And it's just over and over and over again. It's not an exact repeat, but it always rhymes in history.
Somebody mentioned something to me. I was reading something, I can't remember, and then they were referring to Plato's Republic, and so I got it and started reading it, and then you just realize, like, yeah,
it's yesterday.
It's so for anybody listening, that's a great reminder to go back to the classics if you want to understand what's happening in the world. Humans haven't changed. Now, I would say that maybe our tools that we have in society now, mainly coming from mobile phones, are firing up they're intensifying the human frailties. Harley, I teach a class in ethics and finance here in Thailand, and I just kicked off my latest one, and I had about
ethics and finance, like jumbo
exactly.
shrimp.
Yeah, no, that you can do. And I had 80 students, and I asked them this simple question. I ask all of everywhere I go to present, I ask the same question. Raise your hand if you think you are not addicted to your mobile phone. And what percent of people do you think raise their hand?
The liars.
Yeah. Zero.
Not many. Yeah.
Zero. And sometimes I think, as I said to them, I said, one day the youth of this world just may rise up and wake up to the fact that the adults, maybe they didn't do their adult work on allowing kids, to do the things that they've been doing, particularly the mobile phone, the destructiveness of that. There's lots of good, but the destructiveness of it, I don't think that any of us thought. If you remember, Harley, back in the 70s when calculators came out, Texas Instrument and others,
Right.
There was people that were saying, look, if we use these calculators, young people are not going to be able to do arithmetic in their head. They're not going to be able to do long division or multiplication, or they're not going to be able to do any of that. And that was like, some crazy, group of people at that time. Well, of course, that was right. Now, do we stop using calculators? No, but there is a consequence. And so we saw the consequences. And I think about my father who did, all of that calculations in his head. And now I don't. So there's a consequence for everything. Now, I just wanted to talk about what you're doing at Simplify for a couple of minutes, because I think it's important for listeners to understand just a little bit more about, a lot of people that are my listeners are investing in mutual funds, and they're investing in mutual funds in markets that may not even have ETFs or other ways of accessing those fund strategies. Now, in some cases, I've got listeners that absolutely are accessing ETFs and beyond mutual funds. But I would be grateful if you could just kind of explain about, a little bit about the background of what you're doing and why you're doing it at Simplify.
Sure. So, most of everything on Wall Street in finance, if you took 9th grade stat, that's all you need to know. Yeah. It's not much further than that. Of course, not many people like 9th grade stats. That's a problem. But the math is not more complicated than that.
Yep.
The old idea of a mutual fund was people go and pool their money together, and one person or one team manages that money because they're specializing in investing, because everyone can't do everything, So you hire a professional and you do it, in a big group. So each person puts in $1,000, but all of a sudden you might have 100 million in this pool, and he charge you, a low fee. You can put your money in once a day or take it out once a day at 4:00 New York time when the market closed, and you would get in or out at the closing price of the market, and that was it. I'm not saying it's good or bad. It is what it is. What it is. The ETF is basically taking that mutual fund and putting it on the stock exchange so you can get in and out all day long. Are you supposed to go and be buying and selling all day and trading it for speculation? That wasn't the idea, but you're welcome to do it. But the idea was the market goes down in the morning and you want to go and get into the market at 10 o'clock New York time, as opposed to waiting until 4:00 when the market might be higher. And by the way, you have to put your order in by 1:00, so you don't even know what price you're getting in at, right? It could be higher or lower by 4. Yeah. So that was the basic ETF, is taking mutual funds, and then you could have a healthcare mutual fund or a tech mutual fund or an oil fund or a defense fund, and you have like 10, 20 stocks in there. So that was basically kind of, ground zero, level 1 of ETFs. What happened was next, 5 years ago, the SEC changed the rules and allowed us to put derivatives, futures, options, and other things into ETFs. They weren't allowed before. My company, Simplify, that's what we did. We started making ETFs that you could put derivatives into. I'm a derivatives expert. That's why I was at Merrill Lynch 26 years, Wall Street 35 years. I was a derivatives guy. Primarily options, but everything else that's not, in that world. Question?
So to simplify, let's
Yeah.
imagine a typical person has a typical 60-40 portfolio of 60% stocks, 60% or 40% bonds.
Yep.
They're 40, 45, 50 years old, maybe it's 70% stocks, whatever. But there's some stocks and there's some bonds. And they're open for things that could either reduce their risk or enhance their returns. What would be a simple example of a type of derivative that would, come into an ETF that would enhance that return?
Okay,
or protect its downside? I don't know.
Level one, person has his money. He goes and he buys 70% of SPY. That's the basic broad equity index.
Yep.
And he buys 30% of some 5-year investment grade ETF where they buy high grade corporate bonds, 5-year maturity. That's level one. Level two, what we would do is this. We would go and buy futures contracts on the 5-year or the 10-year treasury, listed on the Chicago Exchange, trades like water. Okay. We would go and put that into an ETF. Now, there's no cash required for that. We would take the cash and maybe invest that into some short-term, it's like a 3-month T-bill. And because I won't go to the details, but when you buy that treasury futures contract, there might be an implied interest rate, a borrowing cost of, let's say, 4.5%. And maybe I can go and buy treasury bills at 5%. I would now own the interest rate exposure of the 5-year, 10-year contract, but I pick up an extra 0.5% because I put the cash into a treasury security or some other high-grade security. Now, this, by the way, is not genius. This is what PIMCO did. PIMCO was the first investment bond manager to use derivatives in a large mutual fund. And so now theoretically, you have leverage, which sounds bad. Everyone hates leverage because if you have $1,000, you bought $1,000 of treasury futures and $1,000 of T-bills. Well, you have $2,000 of investments, but only $1,000 of money. So it sounds like you're levered 2 to 1, but you're not, because that 1-month T-bill has no risk to it, right? Now, you could buy other stuff, but that basic structure is leverage. I would call that balance sheet leverage. You have 2 items on your piece of paper. It's not risk leverage. Now, if you bought 2 futures contracts, well, that'd be real risky leverage. So you got to, when you talk about leverage, you got to talk about, is it balance sheet leverage where the risk is unchanged, or is it economic leverage? You really have more risk per movement.
Okay, so let's take a step back for a second and just understand this type of instrument or this type of trade that you've described. Is the regulation that must be in an ETF on its own, or no, you can just bring that strategy into any ETF?
I could do whatever I want. I could put it in any ETF I want. I could make a very simple ETF of just treasury bond futures, and we actually have 2 ETFs where we have that exact, one way on the 2-year, one way on the 5-year. But you could also, use futures in other ways where it's additive. So you'd buy 10-year futures contracts as opposed to 10-year treasuries as a way to get exposure to interest rates because it's more efficient.
Right.
And so we do that, and then of course and we also do. We have really, I don't call them sexy, but kind of crazy trades. Like a trade I created 2 years ago was to buy a 7-year put on the 30-year treasury. That's PIFX, PFIX. That's my baby. We brought this public 2 years ago at 50. It went down to 37 as rates went, down 2 years ago. It's now trading at 102. So it's basically a triple from where it was a year and a half ago. And all this trade was a 7-year put, which decays very slowly. It's not like a 1-month option that disappears in a blink. It's a 7-year option, man. It's very, very stable. And it was a way to go and buy long-term insurance in case rates went higher.
Mm.
And it worked very well. But the trick was you can't buy a 7-year option anywhere except as a professional on Wall Street. And so we have what's called ISDA, ISDA agreement. They're hard to get. We have 4 of them. We have one with each counterparty, one with Goldman Sachs, one Morgan Stanley, one Bank of America, one JP Morgan. And so we can trade with them as a professional, but then take these professional tools and jam them into an ETF. And that's really what we're doing here is we are going and taking professional investment products that civilians, ordinary investors cannot get and putting them into ETFs. We're not trying to make up crazy things with crazy risks.
So let's take that one that you've just talked about that.
Okay.
How would that have, if you're thinking about an ordinary investor that is looking at how to, improve and access these tools now that an institutional investor, gets. So you've said the benefit of what you're doing is, number one, they're just going to get access to the institutional, market, let's say, or the institutional options. And the second is they're going to get the ability to get in on a trading idea of a professional in that space that you put into an ETF wrapper. And I'm assuming that ETF is just a standalone that trade, right? There's no other. Okay. So they're going to get a pure exposure to that. And now if they had a 60-40, or even we could simplify and just say 100% stock portfolio, what would be the benefit of adding, I don't know, 5%, 10% of this trade into that strategy, into that their own portfolio?
We recommend doing 5% relative to the part of your portfolio that's interest rate driven. So if you were 60-40, and if you said my stocks have no rate risk, which is not true, but let's say they don't rate risk, so you had 40% bonds, well, you want 5% of that, so you buy 2% of PIFIX, right? 5% of 40 is going to be 2%. That's how you do it. And it would just smooth out your portfolio. So if rates went up, you'd make money on that product that would offset your losses in your rate products. And it's very slow decay. And if you go back into my website, convexitymaven.com, go look back 2 years. I wrote up something called helicopter defense. And that was the product description, basically. And it'll explain how the product works and what it does. So that's the thing. It's just offering a relatively simple, straightforward idea to civilians because they can't get it ordinarily. And now we can also do crazy. I can do crazy stuff also in these things, but in general, we don't. We just try to make it very simple. So it's called simplify.
Yes, exactly. And my last question is that, are these strategies small and not very liquid, or what if someone wanted to get into this particular strategy that you've created? What's the size or the AUA or the assets under management, or or whatever the measure is?
Oh, PIFIX got to 450 million last year.
Okay.
It's at about 250 million now, and trades, it averages about 150,000, 200,000 shares a day. Okay. I mean, it trades, it's very liquid. Yep. So yeah.
Okay, great. Well, that's a great, lesson on kind of on ETFs, number one, and what's happening. And it's also, let me ask you one last thing, is that if somebody's, going through ticker codes and looking at this stuff, where should they be going to find out more? Should they be going to Simplify's website, or is there?
Go to simplify.us.
Yep.
You have our whole menu there.
Yep.
But by the way, let me just finish the story.
Yes, please.
We had mutual funds close at 4:00 every day. Level 1 ETF was saying, I'm going to have that mutual fund and I can buy and sell all day long. Level 2 is I'm putting derivatives, futures and options into it. Level 3, which is going to start to happen soon, is we make these ETFs active. So what you're going to see happen over time is hedge funds migrate into ETF form. And that way you get rid of all these high fees because, the market won't take it. So you're going to see active ETFs. They're not really here yet, but that'll be level 3 is active ETFs. So putting hedge funds into ETFs.
And are you saying that in, I don't know, 5 years or 10 years, we won't really have much AUM in the mutual fund structure?
I you'll still have a lot of hedge funds out there,
Mm,
but the 2 and 20, that the market will get rid of that
yeah.
fee structure. It's. I mean, as people like to say, is a hedge fund is a compensation scheme masquerading as an asset class.
Well, now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it and then tell us your story.
Well, I'm a U Chicago MBA. I'm a monetarist. I'm a value investor, which is why I've never owned any tech, much to my sadness, because I mean, the PEs and every ratio of these tech stocks is always nuts. And I was looking at the banking sector that got hurt a while ago. This is before COVID, and the banks have finally come back, and the economy is doing fine, and the banks are all trading above book value, except Citibank. And Citibank is trading not only below its book, it's trading below tangible book. What does that mean? When a bank goes and buys another bank, it takes the bank onto its books at where it kind of bought the thing at. But let's say a bank is worth 100 and you pay 120 for it. Well, what do you do with the $20 that you overpaid? Now, the $20 is probably for the name of the company, for its client base, lots of other intangible goodies where there's value. You know, it's rare you buy a company for just the value of its, buildings and assets. Usually there's a value for the ongoing concern of it. And most banks trade above that level. Citibank was the tangible book, and that $20 is called goodwill. And it gets put on the balance sheet because they got to put it somewhere, and it'll show up as part of book value. Because you don't want to take a loss on it an accounting loss right away. Citibank was built by Sandy Weill, by buying lots of smaller banks and other institutions and putting them together. Of course, the great irony is Jamie Dimon was working for Sandy Weill in the early, the 90s, and he was like the genius guy out there, and he should have gotten the job as being the boss, but unfortunately, Sandy gave the job to his daughter instead. That was a bad idea. And off Sandy went, and he became head of JP Morgan, which is now the best bank in the world. That was a sidetrack. So Sandy puts together all these various institutions in the Citibank and has a book value maybe 100. But if you strip away all the goodwill, the tangible book, which is just the value of all the bonds it owns, of its buildings, of everything else, after depreciation, it's basically the value of this company if you could sell it for scrap tomorrow. Well, I mean, really, Citibank, which is one of the too big to fail banks, is going to trade at scrap value. It seemed unlikely to me. So I went and I bought some calls and sold some puts on Citibank stock for a zero cost strategy. And I figure stocks will go up because, as it catches up to its, peers are all trading above their book value, that Citibank, will go and follow along with it. And I'll fund this
can you
call,
explain why you didn't just buy the share? As you said, you're expecting the share to go up. Why did you do the strategy that you did?
Because I had my cash invested in muni bonds, paying 4%, and I'm in a high tax bracket, so it's almost like an 8% yield for like AA rated California bonds.
So you didn't want to take that huge chunk of cash that you had and deploy it into having to buy all those shares for the full amount. Okay.
And it was speculative to some degree.
Yeah.
But I said, the stock's not going to go much below tangible. It kind of can't. Like, it's kind of silly, isn't it? Yeah. And if it did go below, I could probably buy the shares. I wouldn't mind that. Well, comes COVID and everything goes south, and Citibank goes south. You know what, through a goose. And all of a sudden, I'm looking at this thing trading like, 70% tangible. And it's like, oh my God. I just really didn't think it could get there. I mean, I in theory it could, but I just didn't think about that. And this is where, I mean, there's lots of bad trades I have, like so many bad. I could be here for hours telling you about my bad trades. But that one in particular, because really, I just said, I understand how Wall Street works. I understand how banks work, more or less. It's kind of in my wheelhouse. And you really should not trade below tangible if you're an ongoing concern that makes a profit. And they were making a profit. They were adding, the tangible book at the time was like 70. By the way, tangible for Citibank now, well, in a second, they were adding like $2 or $3 a year, $4 a year to tangible. They're making a profit. And it's like, how do I lose on this thing? And lo and behold, down it went. And it got to the point where it's like, well, it's I'm not gonna wait to see how this movie ends. I'm out of this thing. And I got out and took it was probably the biggest trading loss I ever actually took. I put on more of this trade than I thought I probably should have. But it was really like, it was just getting hung up on this value construct. Right. And I really was not thinking about, why is this stock trading, under tangible? Like it made, I mean.
And what was the time period from when you executed the trade and when it went down to the 70%?
I got into the trade in late 2019. As a matter of fact, I wrote about this trade. It's in my library.
Okay.
About this ticket, because I thought it was such a good idea. And then the stock went from I don't know 70-ish down to 40-ish, and when it got to 52, it's like I just pulled the plug and said I'm out.
Okay.
It got down to 41. The stock is now it went all the way back to 85, so I'm sad. The stock's now like 45. And do you know what tangible is?
No.
85. Tangible went from 70-ish to 85 in the last 4 years. This stock is still down basically 50% from where it was, a year ago.
And how would you summarize the lessons that you learned from this?
When something is trading well below what you think value is, you gotta look at why is that? What don't I know? Someone knows. I'm in Chicago. Markets are efficient. They're not always efficient. There are markets gap around. And the whole stock market got rinsed in COVID, and then it's come all the way back up. So you had COVID. That's why everyone's in a liquidity move. I mean, you saw stocks and bonds and gold all go down. That shouldn't have happened. It should have been one or the other. You had a liquidity crisis. Okay, so that made sense. I was just playing value over there, and I didn't appreciate that it was trading below book for a reason. And the reason, I think the reason is that Citibank has never managed to integrate all their businesses together. And they're making money and this and that, but for some reason, they can't make it work. And everyone else has made it work or gotten close to it. You've seen Bank of America, which was obviously they bought Countrywide, and Wells Fargo. They took a massive loss on their shenanigans. But Goldman Sachs, Morgan Stanley. I mean, why can't Citibank do it? I don't know. But clearly it's not working. I'll say this one thing, which is, if you really want to talk about the biggest loss I ever took, but it wasn't really a loss, more opportunity. So Bear Stearns gets into a pickle in 2007, and for subprime mess. And market went down, they came back up, this and that. And then things started going down again in 2008. And my boys, who at the time were, I don't know, thinking 12, 14, 15, they say, and they've seen Bear kind of go under, or I've spoken about it. I'm not sure why 15 would care. Pa, can Merrill go bankrupt? And I said, no, we can't go bankrupt. I mean, at the time, we owned 49% of BlackRock. Okay, 49% of BlackRock we owned.
Sorry, Bears. You're talking about
Merrill
Bears.
Lynch.
Merrill
Merrill
Lynch.
Lynch owned 49% of look at BlackRock now, and we own 4% of that. The reason why is that Merrill gave our entire asset management business to BlackRock, put them together, and we took a minority stake. The trade was supposed to go to Morgan Stanley or someone else, but they wanted 51%. Our guys said, we'll let you go be the majority owner. Genius trade.
Yep.
We owned 20% of Bloomberg. Okay. And by the way, we used to own a lot more than that. Merrill Lynch was the financial backer of Michael Bloomberg because Solomon wouldn't do it. They'd already fired him before. And we owned at the time 20% of Bloomberg was worth, I don't know, 10 billion. It was gigantic numbers. And then we had the investment bank and we had the South Tower, which was the stockbrokers. Merrill's the biggest stockbroker in the world at the time with, I don't know, 12,000 stockbrokers, right? And then with the investment bank. And I'm thinking the investment bank could be worth zero and the company is still worth, 40, 50 billion. Like, how would you possibly get the investment bank worth negative 50 billion? Turns out if you own 45 billion CDOs that go, you indeed can be worth negative 40 billion. And so there we were. We got bought by Bank of America, which was very sad. I owned a lot of stock. Actually, I owned a lot of options, not stock, I owned options at Merrill Lynch that were well in the money when the stock was trading at 95, not so much in the money paying at 12. So I won't say it was a loss per se. It was just an opportunity loss. I cashed in my options and sold stock over the years. But I mean, I did not sell Merrill Lynch. I didn't sell all my stock out, in 07. I mean, which would have been insane to do. I mean, Merrill Lynch had huge drawdowns in 92. In 94, had drawdown in 98, a drawdown in, so I mean, it just kind of goes like that. I mean, I wasn't on margin. I wasn't levered, so I wasn't being margin called. It was, but clearly, you want to talk about dollar loss. That was it. I was a senior managing director for 26 years. I had plenty of stock and options.
So maybe I'll just summarize a couple of takeaways. The first one is I was a bank analyst in Thailand from 1993 until 2003. Which was the tail end of our 1985 to 1995, massive boom. And then by that time, the banks were starting to, collapse under the weight of their loans. And there was a lot of different things going on. But typically Thai banks just lend money. They don't invest in securities so much in the old days. And so if you look at, and they didn't buy other companies, so they didn't have any goodwill. So it was all tangible book. And the interest rate risk wasn't there. Like you can look at US banks and they're sitting on a huge portfolio of government bonds as an example, or maybe other types of bonds that, there's an interest rate risk. If interest rates go up, the value of that portfolio falls. But what happened was that people didn't pay back loans, and our non-performing loan ratio went to pretty much the highest in the world in a banking crisis, which was 55%.
Oh my God, that's a big number.
Yeah, it's huge. And so basically nearly about 50% of the total GDP of Thailand in assets of companies went through the bankruptcy process that they created a whole new bankruptcy process and streamlined it and did a lot of stuff because they had to deal with all of that. So when I look at tangible book and I look at the balance sheet and I look at the loans, I always, come from it from a perspective that these could, that the value of those assets could fall. Now in America, it's a lot different. There's a lot more legal safeguards for banks, and they've got a lot, they're a lot more conservative, maybe, I think a lot has changed over time. So the idea of even having a 5 or 10 or 15% loss on that is pretty low. But the reason why, in my perspective as a bank analyst, the reason why banks never trade at real premiums to their book value that are large and sustainable, except in rare cases, is because of the risk of that loan portfolio or of that bond portfolio, that you have a sliver of equity in a bank, maybe 10% of assets are financed with equity,
Right.
maybe 15%, versus on average, a typical company is about 40%. And so therefore, that sliver of equity is not a problem unless that loan portfolio or that bond portfolio gets just a little bit of a hit. And then next thing you know, that equity could be gone. So for the big takeaway from my perspective for listeners out there is a little bit different. You know, what I'm talking about is a little bit different from what you're talking about, which is the goodwill, the acquisition of companies, and then saying, you know, this goodwill, we should be gaining from what we've paid for. And the goodwill on the acquiring bank's balance sheet is basically saying, I'm willing to pay higher than fair value for this other bank or this other asset because I think I can make a lot more out of that by bringing that into my business. Either I can make it more efficient, or I can distribute its products through my platform, or whatever that is. And so there's my main takeaway for everybody is just, you know, be very careful when investing in banks because of that, mainly because of that sliver of equity. How that sliver of equity gets hit, it can, you know, it can be many different ways. Anything you would add to that?
I'll give you what I think is the most important thing, save it for the end, is when you make an investment, invest enough so that it will be, so you can make a material gain, a gain that's worthwhile, not so much as you'll get taken out. What that means is sizing is more important than entry level. Don't try and pick tops and bottoms. You're not going to do it. As a matter of fact, if you try, you'll probably get it backwards. Forget timing. Size the investment. Pick the size such that you'll make enough. If you're right, you'll make money enough that it's worthwhile. But if you're wrong, you won't get wiped out. And that's the most important thing. Sizing is more important than entry level.
Yep. That's great advice. So let's think about all the experience you have, and let's go back in time to that particular Citibank trade. And I was a head of research at Citibank here in Thailand, and so I have a little bit of connection there. But based on what you learned from this story and what you continue to learn, what one action would you recommend our listeners take to avoid suffering the same fate?
I think don't fall into a value trap. It's easy to do, and the value traps are very, very obvious. The other thing is be careful of single names. Single names are really tricky because you get this lightning bolt effect. So if you think back on the 5-10 years ago, remember when British Petroleum had that punched a hole in the ocean and all the oil came out? If you look at the time, Chevron, Shell, BP, Total, they all had about the same PE, about the same dividend, about the same everything. You know, the five majors, they're all the same. And BP pushed a hole in the ground and blew up, and the stock's down 40%. Is there any way that you could know which one of those five is going to take a lightning bolt? No. And so when you're doing single names, be really careful, because away from all your good work, which can make you right, there's always this kind of lottery effect that you can never predict. And even a solid company like BP, I mean, that hurt. That hurt. Yeah. Same thing, Exxon Valdez, you know, 30 years ago. Where'd that come from? I mean, the guy, he got some seasoned old pilot driving the boat on through there. How's he gonna know? So,
yep.
Be careful of single names.
Yep, that's great advice. I wrote a paper a long time ago called 10 Stocks Are Enough in Asia, with the idea being that if you want to balance between risk and return, I would say the sweet spot for an individual is 10 stocks. You just build a portfolio of 1 or 2, you're dead. But if you build a portfolio of 20 or 30, you might as well own an instrument such as a mutual fund or an index type of ETF. Let me ask you, what's a resource, either of yours or any other resource, that you'd recommend for our listeners?
Oh boy. You know, I just rarely do single name stuff. I tend to be a macro thinker, so I kind of look at the big numbers. I really try to use common sense and figure out, what am I missing?
Right.
Why am I buying this and someone else has not figured it out before me? Unless I'm just buying into the generic, rate, or I'm buying as a long-term buy and hold. I tend to have a 5-year horizon.
Right.
I just don't think I'm smart enough to go and do anything right over the course of a year. And I've done it for a very long time. And I have to admit that I just am not going to go and outsmart somebody in general on these things.
Yep. And I'll mention about the Maven mantra.
Yeah, sure.
For those of you who are meeting me for the first time, let me recite my mantra. Number 1, it's always about character. Number 2, it's never different this time. And number 3, you're born, you are born, you live, and then you die. Prioritize your life. So I think that's a great resource right there. Check it out at convexitymaven.com. I'll have a link to that in the show notes. Last question. What's your number 1 goal for the next 12 months?
Jeez.
What got you off the sofa? That's what I want to know. Out of retirement.
I mean, financially, we're introducing a brand new ETF at the beginning of next month. But away from that, I have 4 kids, having them be healthy. I have my first grandchild came 3 months ago. Focus on things like that. Don't get buried in the office. Look, you got to work hard, and I assure you, I worked very long hours. But you're born, you live, you die, and you're dead much longer than you think. So take your vacation, go with your family, enjoy your kids. Everybody is replaceable. Okay,
yes.
The graveyards are full of irreplaceable people.
Yes, take a walk in a graveyard, and it can really push that home, that message home. Someone once said to me, the Grim Reaper is undefeated. All right, listeners, there you have it. Another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. As we conclude, Harley, I want to thank you again for joining our mission. And on behalf of A Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
We're good, man. Just be careful. Be safe.
And that's a wrap on another great story to create, grow, and protect our fellow risk takers. Let's celebrate that today we added 1 more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.